what should you actually do? Now, this really depends upon your timeline, your goals. What are you investing for? So I have a lot of clients when we talk about investing for kids, there's a variety of reasons why they might want to do it. One, they might just genuinely want to invest for their child to give them a leg up in life. For me, it's also about getting my son or my future kids as well exposed to investing and compound interest and dividends and business as soon as possible. But you might actually have a goal in mind of what you're striving to save up for. Private schooling, could be helping them buy their first home, first car, a wedding, whatever it may be. So all right, welcome back to the Winners Playbook. Josh here, and I'm actually doing a solo podcast today because my regular co-host, Billy Norman, is not in the state. What I'm going to be diving into today is the intricacies and ins and outs of investing for your kids when they are below the age of 18. So it's actually a surprisingly complex area that a lot of people generally do get wrong and they don't have a great understanding about. And I will say, if you're not an advisor and you're not looking at this stuff day in and day out, it is pretty complex to navigate and work your way through. So that's what I'm aiming to accomplish on today's solo podcast. And we're going to actually look at doing a webinar in the next couple of months just to dive a little bit deeper into this and talk specifically around certain products that are out there in the market that are quite good to be using for kids and investing, particularly when, of course, your kids are below the age of 18. So without further ado, we might jump into it. So the key things I want to discuss here is particularly around the taxation when you're investing for a minor. So the whole podcast I'm talking today is just think of anyone, your child, if they're below the age of 18, this is then relevant for them. So I guess what I most commonly see people doing before they get any financial advice is they open up a savings account typically, and they're just going to be investing some money aside for their kids. And that might be coming through birthday gifts, grandparents, whatever it may be, or even the parents just putting a regular amount every single week aside into a savings account. And for some time, for the most part, they've actually generally opened them up in the kid's name already. But this is where it starts to get a little bit complex, because what a lot of people I don't think actually understand here in Australia is how the tax rates work on income for anyone below the age of 18 on investment income. So investment income being that of interest derived from a savings account. So if you've opened up a savings account for your child, the income that's generated, or the interest that's actually generated, gets taxed at some of the highest rates here in Australia, which a lot of people aren't aware of. So how the minor tax rates work, and I'll explain why they've even been put in place, are as such. So the first is $0 to $416 that your child would be earning on investment income, say interest on a savings account in this example. There is no tax. So it's kind of like a tax-free threshold in a way. The next $417 up to $1,607 is taxed at a whopping 66%, some of the highest tax rates, or if not the highest tax rates in Australia. And then anything over $1,307 of interest or income earned on those investments will be taxed at 45%, which is basically the top marginal tax rate here in Australia. So if you put that together, if you're putting that money in a high interest savings account and say that's generating 5%, if you can be taxed as high as, well, 66% on a portion of that interest, or the majority of it when it's earning over $1,300 a year at 45%, you're virtually losing half of the return by way of simply just taxes. So it's something you really need to have a good understanding about, because the reason why these rules exist, of course, as well, is basically the government or the ATO preventing us as parents, and I can say as a parent, investing in your child's name and getting a greater tax outcome. Because if they're not working, it would be so easy just to put some investments in their name, get all the benefits from the regular tax-free thresholds, and as opposed to investing in your own individual name, which you could be taxed as high as 47% if you're earning over $190,000 here in Australia. And just to talk about the tax rates for adults, you earn up to $18,200. You don't pay any tax on that income. $18,200 to $45,000, you're taxed at 15% plus the Medicare levy of 2%. Next tax bracket is 32%, including the Medicare levy, which is $45K to $135,000. And $135,000 to $190,000, you're taxed at 39%, including the Medicare levy. And then any dollar earned over $190,000, you're basically going to be taxed at 47%. So that's how it works for anyone who is over the age of 18, or anyone who is defined as what's called a accepted person. So now we're going to get into the weeds of you want to invest for your kids, but you're not sure how to start, where you need to start, or maybe you've already started investing for your kids, I should say, and you're wondering if it's the right thing to do for the next 10 or 15 years, depending on how old your child is. What you need to start by understanding is what a accepted person is. So again, talking for any child below the age of 18, they will be defined as an accepted person if they're basically working full-time. There's a couple of other situations where they're defined as an accepted person. That's a person with a disability, a person with a double orphan pension. I've never seen one of those personally myself, but basically if you've got a child and they're working below the age of 18, which sometimes is happening, then all of what I'm about to say is actually totally irrelevant, because they can then benefit from the regular adult tax rates. So all of what I'm about to get into now, if your child's below the age of 18 and they're working full-time, totally irrelevant. They're going to be taxed and treated exactly in the same that you are as an adult. So an accepted person basically means they have to be working full-time. If they're not deemed to be an accepted person, this is where we start getting into the weeds of it. So this is where you have to start looking at, do they have what's called accepted income? Which accepted income is basically employment income. So they're not working full-time. They might be working part-time or casual. There's a bunch of other aspects of what is defined as accepted income, which could be taxable pensions or payments from Centrelink, compensation, super or pension fund benefits, income from a deceased person's estate, including income derived from a testamentary trust, etc., income from your own business. I have seen this before with clients where they've had their kids kind of operating a small little business. But for the most part, what you need to think about there is accepted income is basically just employment income. So if your child is working a few hours a week, casual or part-time, that is deemed to be accepted income. And it's important to understand how that would then be taxed. Is that income that's from employment income, that is just going to be taxed at the normal income tax rates for adults, not the minor tax rates. But what you need to understand in that situation, if you're investing for your child or your child is investing below the age of 18, they're only working, say, part-time, that part-time income will benefit from the adult tax rates, but any of the income derived on their investments will be taxed at the minor tax rates, okay? So this is something you've got to be very careful upon understanding, is all of the investments that they will be making, or any income that is generated, more importantly, from those investments, will be taxed at the minor tax rates. So you need to have an understanding around what is the definition of an accepted person and then what is defined as accepted income, which put simply is you're an accepted person if you work full-time. Don't need to worry about anything that I'm talking about here. But if you've got some accepted income, so you've got some employment income, that will be taxed at the adult rates. Anything outside of that is taxed at the minor rates on investments, which is what we are talking about here today. So moving on from that, you basically got to then look at, okay, you want to do some investments for your kids. We've looked at the accepted income, accepted person. So for the most part, most kids below the age of 18 generally aren't going to be working full-time, but of course some will be, but let's assume they're not. What are your options? Most commonly, as I said, clients are putting money into a bank or a savings account for their child. And I personally think that's probably one of the worst things that can be done, depending upon the situation, for the very reason being, you're getting a capped rate of return, which these days, because of where interest rates are, is roughly around about 5%. But then you're going to be taxed on that 5%, whether it's the adult tax rates or the minor tax rates, which could be as high as 47%. Which means if you're getting a 5% rate of interest on that high interest savings account, you're nearly going to be losing half of that in a lot of situations by way of taxes. Of course, depending upon what your income and your marginal tax rate is. But the important thing there is you're not getting any capital growth on those investments whatsoever. Those investments are not compounding whatsoever. So this is then where we get into what are your options? And that's where you've basically got two options. You're either going to be investing for your kids in defensive assets, such as a high interest savings account, a term deposit. Maybe you put some money in an offset account. I've seen some clients do that. If they've got a mortgage, they've set up an offset account. They can't obviously put that in their kid's name, but they call it, Riley's future savings, and they start bucketing some money away for that. That's probably a better way of doing it than a regular savings account. But the money, of course, doesn't actually sit in the kid's name in that fashion at all. But if you're investing in growth assets, that's where we're looking at investing into predominantly the share markets, getting some share market exposure, looking at exchange traded funds, looking at managed funds. That's where you're going to be getting more growth and return on those investments longer term. So say an average high interest savings account long-term gives you 4 or 5%, historically investing into the share market in Australia and around the world might give you on average 9 to 11%. Compounding that is going to be significantly different than investing into a high interest saver that gives you a 5% return pre-tax, and then after tax it's going to be a lot less. Whereas if you're investing in shares and the right investments, predominantly they might be more growth orientated, so you're not even getting much income from those investments to begin. So there's actually no tax concern at all for the kids, because you're getting the return by way of growth and not income, and you're not presently taxed on growth in any of your investments, ultimately until you sell, but you are taxed on income. So that's generally where I'm looking for clients if they're going to be investing for their kids, depending upon the time horizon, is looking at a more growth-orientated approach. Because if you compare the scenario side by side, compounding over 10 or 15 or 20 years, that option is going to absolutely destroy that of putting money in a savings account long term. In saying that, though, this is where it starts to get a little bit more complicated, because things to consider here is you can get your child a TFN, the tax file number, at any age, and you can open them up a bank account. And particularly if you're going to be investing for your kids, you might want to open them up a bank account for the reasons that I'm about to go into. The complicating factor of what happens here if you're investing for your kids is essentially how you give those investments to your kids once they reach age 18. And so what people commonly think about here is they might even just have some investments in their own name, some shares, and you as the parent, you might just invest in your own name. But then when you want to give that money to the kids, it's going to be a taxable event, because you have to sell the investments, or even if you want to transfer it to them, it's going to be a taxable event. It's very similar to having property and then wanting to give a child property in future. And I've had clients that have done this. That will be a taxable event, even though you could theoretically sell it to them for whatever you like, $100 or whatever it may be. You're still going to be taxed at the fair market value, and there'll be stamp duty for your kids on the actual acquisition itself. But disregarding property and talking particularly around share investing in ETFs, managed funds, and so on and so forth, you want to get this right so there's no taxable event, ideally, by the time the child reaches age 18, and then the investments transfer solely over into their name. So what do you need to think about here is essentially the common issues that arise here is whose tax file number is quoted. Is it child's or the adult's? And then what we need to be looking at here is you can quote your child's TFN on a investment account. There is another way of doing it where you do it what's called an informal trust. So there's a various investment accounts and bank accounts you can do this with, whereby you open the account up, your name goes on the account as trustee for your child. So it's called an informal trust. And then it depends upon whose tax file number is quoted there is a real important point, which I'll get into. Or you could have a formal trust structure, which is something I do have, where you could be investing for your child through that as well. But unless you're in business and a few other reasons, you probably wouldn't be setting up a formal trust structure just to invest a few dollars for your child. If it's going to be a lot of money, that might be a different conversation. And that is probably something very key to understand here, is it really depends upon how much money you're going to be investing for your child longer term will determine which way you should go about doing this. Like if we're talking $5 or $10 here and there, and it's not going to materially build up to much money by the time of age of 18, setting up and doing some investments there is probably not greatly important, but it really does depend upon how much money you're looking at trying to invest. So what happens here is, let's just say you open up an investment account, you want to do that for your child, and then you're like, okay, whose tax file number am I quoting in these scenarios? Put simply, if you want the investments to be transferred to your child by the time they reach age 18 and not pay any tax on that transfer, basically the only way that it can be structured is if the investment is genuinely held in trust for a child, even if it's an informal trust arrangement. So they're the beneficial owner. And what that means is you need a tax file number for your child. So you open up the investment account, your name goes on it in trustee for your child. And then what happens is the child's tax file number is quoted. And then any income derived, say, over the next 10 or 15 years before they reach age 18 is taxed at the minor rates. So it will be taxed at the minor rates. Really important to understand. Whereas if you quote your own tax file number, it's a very high likelihood, well, the income, first of all, will be coming under your tax return, but the beneficial ownership will most likely not look to be for the child, it would look to be in your name. So you're just owning those investments essentially for yourself, even though if you have your child's name then on there. And then when you go to transfer that to them when they're 18, it's going to be a capital gains tax event in that scenario. So the way to generally be doing instruction this correctly would be that the account is then opened up, you're quoting the child's tax file number, and your name still sits on it, but then all of the income over the years is taxed in their name, and it is not taxed in your name. Critical to understand as well, a tax return must be lodged for a minor once their income is exceeding $416 per year. There might be some franking credits and other things that you might want to get back as well. But in that situation, by the time your child reaches age 18, your name can basically be removed on the account. There is no exchange or change in beneficial ownership of the investments, and therefore there is no taxable event on those investments whatsoever, which is a massive win. Because if you were doing this and investing a lot of money for your child, which is something I'm doing for my son, you wouldn't want to have a taxable event, in my opinion, at age 18, particularly if you're investing in a high growth portfolio that's growing at 8 or 10% long term. That could be quite a lot of money by the time your child reaches age 18. And if that's just going to be a mandatory tax event, that doesn't feel and sound good to me. It's not something that I want to do, is just hand over unnecessarily dollars to the tax office. So this is where you'd want to be really making sure you get this structured right from a tax file number perspective, who's taking the income and declaring on their tax return year on year, to avoid any problems by the time your child reaches age 18. So again, if you're quoting your child's tax file number on the account, income will be taxed at their minor tax rate. So that you could then argue and say, well, Josh, isn't that a problem? Because you said it can be taxed as high as 66% before. Well, that could be if you're predominantly investing in a high income portfolio. That's for you to choose. However, most of the clients I'll be working with doing this, we're going to be investing in more of a high growth orientated portfolio, which doesn't derive a huge amount of income that we need to worry about for tax purposes. It's going to be predominantly invested in growth assets, which we know, again, as I said earlier, you're not getting taxed on your growth whatsoever. And then by the time, say let's just say you invest $1,000 a fortnight, by the time the child reaches age 18, say that's worth $500,000 or whatever the figure may be, there's no taxable event on the transfer there whatsoever. Whereas if you've quoted your tax file number and you've made some of these mistakes that I've been mentioning, then there's going to be a taxable event by the time you want to give the kids the money at that point in time. So that one is really, really critical to understand, because you don't want to get to 18 and you've got this structured incorrectly and there's an unnecessary taxable event at that point in time. One step further though is, if you want to structure this correctly as well for the kids and everything that I've just said there, opening up or making sure you can prove that the child has always been a beneficial owner to ensure that the investments can be transferred over to them without triggering CGT does require some good record keeping. So what you generally want to then be doing here is having a separate bank account for your child for where maybe pocket money goes, gifts from the grandparents or other family members, etc. So it's clear that's then all going into there, or if dividends are being paid out, it's going into that bank account and not yours, because then it's going to get mixed up in terms of from a tax perspective. So if you're doing this really clean, the child's got their own investment account, tax file number is quoted on that, your name is listed as the controlling sort of trustee. There is also a bank account for the child as well, and that's where kind of all money flows in and out of. If any gifts, if Nana's giving any gifts to your kid for birthday, Christmas, whatever it may be, deposit the money in there. The money goes from there straight over into the investment account. So that's how you're doing it if you're doing it in a very clean fashion to avoid any headaches come time of reaching age 18. So getting to closure here, what should you actually do? Now, this really depends upon your timeline, your goals. What are you investing for? So I have a lot of clients, when we talk about investing for kids, there's a variety of reasons why they might want to do it. One, they might just genuinely want to invest for their child to give them a leg up in life. For me, it's also about getting my son or my future kids as well exposed to investing and compound interest and dividends and business as soon as possible. But you might actually have a goal in mind of what you're striving to save up for. It could be private schooling, could be helping them buy their first home, first car, or wedding, whatever it may be. So first and foremost, before you start doing anything of this, you just got to actually think about what are you investing for here? What's the actual aim? How much dollars is required to achieve whatever you're trying to achieve? Because then that's going to very much determine what you should be putting your money into. Because If it's a rather short time horizon, investing in growth assets might be quite risky. And I'll give you an example of that. So I had a client who had a couple of kids. There was a bit of an age discrepancy between the kids of about 5 or 6 years. So they wanted to set up investments for their kids for private schooling purposes, but one of the kids was going to be going into school in a couple of years. The other one had a longer time horizon. So what we actually did in that scenario is suggested to actually invest for the child who's about to go into schooling the next couple of years, just in their regular offset account. For the very reason being, they're going to need that money out within a 2-year time horizon, which is a very short time horizon. So putting that into a growth-orientated portfolio where there's fluctuation, there's volatility, that's actually quite a risky play in my opinion, that type of scenario. Whereas the younger child who had a longer time horizon to invest until they were going to go into school, that's where we did invest into a high growth portfolio because we've got a long enough time horizon to ride out the volatility and the ups and downs in the market. So you really do need to consider strongly here what your timeline is, what are your goals, what are you actually doing this for? And then looking at the available options out there in terms of investing in shares, investing in ETFs, the trust structure or not. I personally use also an investment bond. An investment bond can be a really good option in the right circumstance for investing for kids. But that really comes down to what you as the adult, the parent, what your tax position ultimately looks like as well. If you're a high income earning family, say mum and dad both over $190,000 each, using trust and investment bonds, that might be a good case scenario. Because with an investment bond, the tax rate is a maximum of 30%. And after 10 years' time, they can be sold entirely tax-free. You can transfer them to the child at any point in time. It's not a taxable event. There's a lot of flexibility in the use of an investment bond, but they do have some rules that you need to be sticking with and bound. So if you're only investing small amounts of money, they're probably not a good option. But again, this is where you need a consultant or advisor or someone who knows what they're talking about in terms of helping you determine what you should be doing if you don't know. But I personally do look to use investment bond to invest for my son long term. But then finally, looking at the right account, because there is only a handful of investment providers out there that actually provide accounts investing for children below the age of 18. So there's only a small handful of them. But the drawback to investing for kids historically has always been the investment accounts that are out there, the fees on those accounts, unless you're investing a decent amount of money or a particular amount of money, it wasn't worth it. Because if you're investing $5 or $10 here and there for your kids, or there's gifts coming in of $50 from Nana or whatever it may be, and you're putting that into some of these regular investment accounts, because of the admin fees and the fees on the platform, it basically erodes all of the benefit because the fees would just eat away at the returns or the money that's gone in. But in the last couple of years, there's been a lot of great platforms that have actually come out to market, which some of them, which I won't name names on the podcast because we will be doing a webinar on this, charge no fees whatsoever, no strings attached as well. So you can open an account in your child's name and be investing as little as $5 or $10 a week into virtually anything that you like. Very broad investment menus, particular shares, high growth ETFs or managed funds, Australia, international, space ETFs, cryptocurrency, whatever it may be. There are some really, really good platforms out there, and some of them don't even charge any fees whatsoever on these accounts. So every dollar you're putting in, those dollars will be getting invested. Whereas historically, using general investment accounts, you'd be too worried about the fees you're going to be paying unless you're investing a decent amount or a certain amount of money to make it beneficial investing on those platforms. So there are some really good platforms that have come available and come out on the market. I will cover those in our upcoming webinar to look at them side by sides and the differences ultimately here. Yeah, and ultimately I think one of the best things of doing this and reasons why you would do it is just getting your kids educated, because financial literacy is, in my opinion, not where it needs to be in Australia. And this is why we do have a financial literacy program for schools at Link Wealth, and would love anyone listening, if you're in Melbourne or depending upon where you are in Australia, we are always wanting to get into more schools and do these financial literacy sessions for students in year 10s to 12 in terms of getting them better prepared for life after school. Is something I'm deeply passionate about. But ultimately, in closing, investing for your kids in Australia, unfortunately, the Australian tax system is quite straightforward in some regards, but in certain regards, it's also quite complex. And I would say investing for your kids It's not as simple as it actually seems, but really you do need to be considering why you're investing, how much are you going to be investing to ensure you get the structuring right from the get-go, so you do not, so you do avoid any heartache and frustration by the time they reach age 18 and causing any unwanted taxable events. So in saying that, I am going to close out today on my solo podcast. I hope you got some really good value out of what I was discussing. And as always, if you want to reach out, feel free to go to our webpage. You can check out all the advisors in the business, or stay tuned also for the upcoming webinar that we are going to be doing. It's going to be covering off this in a bit more detail, but also looking at some of the products related in the market that are quite good for investing for kids. So we'll leave it there, and I'll catch you next time on the Winners Playbook. Thanks for listening to the Winners Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.